$100, not 1,000, not 10,000. $100, the amount sitting in a forgotten savings account, the amount you'd spend on a dinner without thinking twice, the amount most people would not consider a serious financial instrument by any definition. And yet, there are documented, verifiable cases of traders who started with exactly that amount, or less, and built portfolios worth millions, not through inheritance, not through a lucky bet on a single stock, not through a viral moment or a social media following that monetized overnight. Through a process, a specific, repeatable, mathematically grounded process that most people never learn because they're too busy looking for shortcuts to study the actual path. Today, we're going inside that process, what the math looks like, what the markets involved actually are, what the psychological architecture of someone who pulls this off looks like versus the overwhelming majority who try and fail, and most importantly, what the critical decision points are where the path either continues or collapses. This is not a fantasy, this is a framework, and frameworks, unlike fantasies, can actually be followed. Let's build it from the ground up. Why $100 is actually enough to start, and why most people don't believe that. The first obstacle is psychological, not financial. When someone says, start with $100, the immediate internal response for most people is dismissal. $100 feels like a rounding error. It feels like the kind of advice given to people who don't have real money, a consolation prize for not being able to participate at the level that actually matters. That response is understandable. It is also exactly wrong. And understanding why it's wrong is the foundation of everything else in this video. The function of starting capital in trading is not to generate wealth directly through its size. It is to generate proof that a strategy works, proof that you can execute under real market conditions with real money on the line, proof that your psychology holds when there is something to lose. A $100 account trading with discipline and a documented edge is not a small version of a real trading account. It is a real trading account. Every principle that governs risk management, position sizing, entry criteria, and exit discipline on a $1 million account applies identically on a $100 account. The skills are the same. The psychology is the same. The process is the same. What changes is the size of the outcomes, and size, through compounding, is a time problem, not a starting capital problem. The traders who turned $100 into millions didn't do it because they had a secret. They did it because they treated $100 with the same seriousness that most people reserve for $100,000. That relationship with capital, independent of its current size, is the first and most important differentiator. Not every market is accessible at $100. Let's be precise about where this journey actually happens. Forex. The foreign exchange market remains the most accessible entry point for small capital traders. Micro and nano lot sizing, available on most retail platforms, allows position sizes as small as 10 cents per pip movement. You can execute real trades, manage real risk, and build real experience on a $100 account without a single trade being able to wipe you out if your risk management is sound. Leverage amplifies both gains and losses, which is why the process matters more than the capital size. Crypto. In 2026, cryptocurrency markets offer fractional ownership of assets and 24-hour trading with no minimum position requirements on most major platforms. Volatility, which most retail investors fear, is precisely what creates outsized percentage moves that a skilled, disciplined trader can capture. A 15% move in Bitcoin is routine. A 15% annual return in an index fund is exceptional, the same percentage in a different instrument. Options on stocks. With the expansion of zero-day and low-premium options contracts on retail platforms, it is now possible to express a directional view on a major stock or index with a $30 to $50 options premium. The risk is defined. You cannot lose more than the premium paid, and the potential return on a correct directional call can be multiples of the initial premium. Prop firm challenges. This is the accelerant that changes the entire timeline for traders with small capital. Funded trading programs, where you prove a strategy on a challenge account and get access to $10,000, $50,000, or $200,000 of firm capital in exchange for a profit split, are now a legitimate pathway. A $100 challenge fee can unlock access to institutional-level capital within weeks for a trader who can demonstrate consistent disciplined performance. The market is not the barrier. The barrier is always the trader. The math. What the compounding actually looks like. Let's build the numbers honestly. No inflation, no manipulation, just math. The target is consistent percentage returns, not 500% months. Those exist in viral stories and almost nowhere else. Consistent returns. The kind a disciplined trader with a real edge generates repeatedly over time. We'll model two scenarios, a conservative 15% monthly return and a more aggressive 25% monthly return. Both are achievable by professional traders with documented strategies. Neither is guaranteed. Both require everything we'll discuss in Segment 4, the 15% monthly model, starting at $100, month 3, $152, month 6, $231, month 12, $535. Still small. This is the test of faith, the period where the math is real, but the numbers don't feel like they mean anything yet. Month 18, $1,240, month 24, $2,876. 2 years in, under $3,000. Most people have quit by now. The ones who haven't are the ones who will see what comes next. Month 30, $6,621. Month 36, $15,300. 3 years. The curve is beginning to bend. The same 15% that made you $15 in month 1 is now making you $2,000 in a single month. Month 48, $81,600. Month 60, $434,000. Month 72, $2,300,000. 6 years, starting from $100, at a consistent 15% monthly return. The 25% monthly model accelerates dramatically. Month 24 puts you past $50,000. Month 36 past $1 million. Month 48 past $20 million. Now, critical context. These models assume no withdrawals, perfect execution, no losing months, and continuous compounding. Reality has drawdowns. Reality has losing streaks. Reality has months at 8% and months at negative 12%. But the framework is real. The mathematical engine of compounding at high percentage returns on growing capital is the mechanism that makes this possible. And the traders who actually did it, who went from small accounts to 8 figures, did not do it because they found a magic strategy. They did it because they protected this engine. They never let a single bad decision destroy the base that the compounding depended on. Protect the base. Let the math run. That is the entire strategy. The 4 things that actually determine if you make it. The math is simple. The execution is where most people break. And the execution comes down to 4 things. Not 20, not 100, 4. 1. Risk management that is non-negotiable. Every trader who built significant wealth from small capital operated with a defined maximum risk per trade, 1% of account value, maybe 2, never more. This is not conservative, it is structural. At 1% risk per trade, you can lose 50 consecutive trades and still have 60% of your account left. The math allows for survival through any realistic losing streak your strategy will encounter. The traders who blow up, and the majority do blow up at least once, almost always violated this principle in one of 2 ways. They sized up too aggressively trying to accelerate the timeline, or they held a losing position past their stop loss because the ego refused to accept being wrong. Both decisions come from the same place, impatience with the process. And impatience is the single most expensive personality trait a trader can have. 2. A strategy with a documented, tested edge. Not a feeling, not a YouTube setup, not something that worked 3 times last week. A statistically documented edge, a strategy that, over a minimum of 200 to 300 historical trades, shows a positive expectancy, meaning the average outcome per trade, when you multiply win rate by average win and subtract loss rate by average loss, is a positive number. Without documented edge, you are not trading. You are gambling with extra steps and technical analysis vocabulary. 3. Emotional architecture that survives adversity. You will have losing streaks, extended ones. There will be a week, maybe a month, where every setup fails, every position goes against you, and your account is down 15% from its peak. In that moment, The temptation to abandon the strategy, to change the system, to revenge trade back to break even, that temptation will be stronger than any market force you have ever encountered. The traders who made it have a specific response protocol for drawdowns. They reduce position size. They go back to the data and verify whether losses are within the expected parameters of the strategy. They do not change the strategy mid-drawdown. They execute the next valid setup with the same discipline as the first trade they ever placed. This is harder than any technical analysis. It is the actual work. 4. Obsessive journaling and review. Every trade, entry price, exit price, position size, setup type, emotional state during the trade, market conditions, result. Not to celebrate winners, to identify patterns in losses, to understand which setups work in which conditions, to build a feedback loop that makes the strategy sharper over time. The traders who plateaued are almost universally traders who stopped journaling. The ones who kept improving are the ones who treated every trade as data in a study they were running on themselves. The journal is the competitive advantage. Most people don't maintain it past the first month. The ones who do are the ones still in the market 5 years later. The prop firm pathway. How $100 becomes $100,000 in capital. This is the piece of the modern trading landscape that fundamentally changes the timeline, and most people don't fully understand how it works. Proprietary trading firms, prop firms, fund traders who can demonstrate consistent, disciplined performance on evaluation accounts. The model is simple. You pay a challenge fee, typically between $100 and $500 depending on the target account size. You trade the evaluation account according to defined rules, hit a profit target, stay within drawdown limits, trade a minimum number of days. Pass, and you get access to a funded account. $10,000, $25,000, $50,000, $100,000, $200,000, and keep between 70% and 90% of the profits. The implication for small capital traders is significant. A trader with $100 and a proven strategy doesn't need to wait 6 years for compounding to build their capital base to meaningful size. They need to pass a challenge. And challenge fees for accounts in the $10,000 to $25,000 range are accessible to anyone with $100 to $200. Pass a $25,000 challenge. Trade it to $30,000. Scale to a $50,000 account, then $100,000. Prop firms with scaling programs can take a consistently profitable trader from $25,000 to $200,000 in managed capital within 12 to 18 months. The math on 15% monthly returns changes dramatically when the base is $200,000 instead of $100. Month 1 on the prop account generates $30,000, more than the entire starting journey took years to build. The prop firm is not a shortcut around the process. You still need the strategy, you still need the discipline, you still need the documented edge, but it is a legitimate capital accelerator for traders who have done the foundational work. And in 2026, it is the most viable pathway from small retail capital to professional scale returns. Where the path collapses and why most people never complete it. Let's be honest about the failure rate, because it is high, and understanding where people fail is more useful than pretending the path is easy. The first collapse point is impatience in the early months. The compounding curve is flat at the beginning. $100 becomes $115, becomes $132, and it feels pointless. At this stage, traders either abandon the system and go looking for something that grows faster, which inevitably means taking on more risk than their capital and skill can support, or they stay the course and build the foundation. Most leave. The second collapse point is the first significant losing streak. A trader who has been profitable for 3 months hits a drawdown. Everything they believed about their strategy gets interrogated. The temptation to change the system, increase position size to recover faster, or abandon trading entirely is overwhelming. Most people collapse here. The ones who don't are forever different traders. The third collapse point is success. This sounds counterintuitive. But a trader who goes from $100 to $5,000 through disciplined execution often makes a fatal error at this stage. They decide that their proven success justifies abandoning the risk management rules that created it. They size up beyond their framework. They take setups that don't meet their criteria because they feel confident. They confuse a working process with personal infallibility. And the market, which is indifferent to confidence, corrects them violently. The traders who made it from $100 to millions survived all three collapse points, not by being immune to them, by having studied them in advance and building a system with guardrails against each one. You don't need luck, you need architecture.